In this video, I'll tell you why I think Apple stock is not a $3 trillion company just yet, and why it is worth $135 a share. I'm not saying it's going to that price, obviously. The valuation depends on the buyers and the sellers of the market. But if valuation does matter, I think it should go to that price, or at least it should trade sideways till the EPS catches up. I called the same for Baba stock, so if you haven't seen that video yet, you might want to check that one out. In my last video, I screened the top 50 US companies by market cap. Check that video as well. Apple was in my avoid list along with the 29 others. I think everyone in the world wants a piece of Apple stock, but obviously not everyone is willing to pay more than what it should sell for. We'll be screening Apple stock through our three metrics to see whether the stock is trading at overvalued, fair, or discounted prices. From there, we should see if the stock is a buy or not at current prices. These metrics can also give us the best prices to buy the stock. Apple is currently trading at $154.73 with high price of $182.94. That's 15.42% of the highs. Current market cap of $2.53 trillion with PE ratio of 25.69. It gives out a cute dividend of $0.88 per share, a yield of 0.57% of the current price. If you're in it for the dividends, I think it is safe at only 15% of their current earnings. First metric, we want an EPS multiple less than 3. It's 4.27. We get this by dividing the PE by the EPS. This metric tells us how much we're paying for the stock based on their current earnings. It is above my threshold, but is it worth paying for? I've included here the EPS history and OSN, or number of shares, over the years. We want EPS increasing and OSN decreasing. Second metric, we want to pay $1 or less for 1% of the money they're making. This is based on the lowest yield between the net income and the free cash flow yields of the current year and the 5 and 10-year average yields. This metric tells us how much we're paying for the stock based on their yields. What you see here is revenues deconstructed. The above values are in billions. Below are in percentages of their respective revenues, the costs and expenses they use to make those revenues, the income they get off of those revenues, and free cash flow they generate off of those revenues. I'll show you the relationship of the cells. I've also included here the revenue growth, as my second metric does not account for the loss of revenues. Like any other processes you know out there, they will still be making the same yields even with declining revenues. That's why it is important for these companies to maintain or grow their current revenues. Of the four highlighted values, we'll take the lowest yield to divide the current PE. Why the lowest yield? And why did I include the net income yield? We want to take the lowest yield because we want to base our assumptions at the lowest possible yield. I've included the net income yield as I thought it is also important, as EPS is based on it and not on the free cash flow. Our discount is 1.15. Actually, it's not a discount, but a premium. But anyway, it means we're paying 1.15 times their yields if we buy the stock at the current prices. Third and last metric, we want to know our discount compared to when the markets have valued the stock before by looking at their historical PEs. I have here two historical data, one from Guru Focus, where this data is readily available, and the other from Macro Trends, where I took the PEs manually from a range of consolidation the stock has traded before. You'd see here the highs and the lows of PEs it traded and the number of quarters and years I took the data from. Of the two highlighted values, we'll use the lowest historical PE to divide our current PE for the same reason we want to base our assumptions at the lowest PE. We have a discount of 1.64. It means the stock is trading at a higher PE now. In conclusion, the stock beats none of my metrics. The stock is overvalued as it trades at 4.27 times earnings, 1.15 times their yields, and 1.64 times their historical PE. I don't own the stock. I don't think we should pay premium for the stock as revenue growth is at single digits. Would I buy? No, not at these prices. Here are my entry PEs and prices, just a few PEs below their yields for my margin of safety. The fair value of Apple stock based on my three metrics is $135. This is what we get when we multiply the EPS in my first metric of 6.02 and the lowest yield in my second metric of 22.31. I'm okay with paying the stock at fair values of $135, but not at 155 US dollars like it's trading now. I think I'm keeping Apple in my avoid list. This three metric I use is designed to determine the best PE to buy a particular stock, as I believe PE is the price you pay for in a company. This is my process of screening stocks to buy at what PE by looking purely at the company's financials and none of their fundamentals. If you like to invest in these companies, I'd advise you to look at their fundamentals, their charts, and more of their financial data and metrics like long-term debt, some important financial ratio, etc. As always, do your own research.